Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. People, it is, see, Dan gets upset, Elizabeth, because I start talking before we come on screen, but people can hear me. So it's like this magic of...
Yeah, I don't know. Bill, can they hear us? Right out of the gate. Why don't you just take a beat, guy?
Hello, everybody. It's 11 a.m. on the East Coast. This is G Swizzle in the middle. You'll see Elizabeth Thomas, she of SoFi. And, of course, Dan Nathan is wearing a ski jacket because apparently he's going to, like, Killington later to sort of shred the slopes or something. I'm not exactly sure what. By the way, before we get started, if it's Wednesday, which it's not, but if it's Thursday, it's what? Yes, it's Butter's bitch. And I know there are a lot of people watching that were saying that with me in unison because that's what we do. It's called a Pavlovian response. Last night in the National Basketball Association, now this is supposedly the best players. What are you guys looking at? You were just looking at something.
We have a little thing going. If you were in here, you would have been participating with it.
Anyway, please, I will continue. These are supposed to be the best basketball players and then subsequently the basketball teams in the world. There was a score last night that I haven't seen in recent memory. Maybe Bill Hockman can speak to this, but the Knickerbockers of New York defeated the Nets of Brooklyn 120-66.
Holy.
Yeah, that's embarrassing. That's the largest margin of victory in the history of the Knicks franchise. Embarrassing if you're a Net fan. First of all, it's embarrassing to be a Net fan, number one, but it's embarrassing to be a Net fan that loses by 54 to the Knicks. That's all I have to say for now. Dan, back to you.
Yeah, so I have a good friend of mine, without doxing him.
We'll say him or her.
He listens to the pod. He's not in the markets, but you have been talking about gold. Liz has been talking about gold.
For like is that Tommy Vitor?
I mean, I'm bored of talking about.
I'm not doxing.
Yeah, that's right. Totally right. See the way? I mean, I would love to play poker against you because I mean that's amazing.
All right, so
hi, Tommy.
My friend, stop. My friend has been listening to the pod for years. He's a big Liz Thomas fan. He's a big Guy Adami fan, but he became a big gold fan about a year ago. But this person, so he hits me yesterday with a day chart of the, it was from the Kobayashi letter, which you're a big fan of, Guy.
Yes.
And he shows me the move in gold and silver. It's obviously opposite of that of the stock market, right? This is after the taco trade was in full effect. And, he basically was saying, I saw something strange today, Guy. I saw something strange today.
Yeah, it's Godfather 2. I'm very familiar with where you're going.
Just the quote, and then we're going to get into it, okay?
What did you say? Well, what does that tell you, Dan?
It tells me they can win, okay? And so here's the thing, Liz. When you see gold like that, it looks like a panic move. And then maybe Amanda can pull up the chart.
Hold on. What are we talking about? Gold like what? During taco or now?
Yesterday.
Just the way it's been trading.
And then I see something strange today. They can win. The gold bugs can win here. Liz, so just do a 2-day, 3-day or something like that. You had that huge breakout. Like you see that. It kept on going. You see that big reversal. It came back. But look at that right now. I mean, what do you... That is one of the risk assets out there to me that is most interesting if I'm trying to put my finger on the pulse of investor sentiment.
That's an interesting proposition. Yeah, because I still think gold is actually under-owned by a lot of investors. I think it's overwatched, but under-owned. I don't think that there are as many retail investors in it as we'd all like to believe. And I don't think that's necessarily what drives all that volatility. The reaction in gold right now, I think, is more emblematic of the fact that gold has become the symbol of central banks and of sovereign wealth and of basically what's going on in currencies, what's going on in yields, and whether or not the world trusts some of its reserves anymore. Now, the demand that has been underlying gold, I still firmly believe is sticky demand, right? The central bank demand, the institutional demand, that will stay there. It keeps a floor on that price. Some of this volatility, I think, is in reaction to the geopolitical risk. We could probably overlay a geopolitical risk chart and take it down to the 30-minute marks, right? And I bet gold will show us exactly what's happening there, because now everybody's in on this trade, meaning everybody around the globe. Everybody is avoiding dollar weaponization. nobody wants to get caught up in that. Nobody wants to fall victim to that or be controlled by that. So the option is gold, because I think we've all also decided that the option isn't Bitcoin. So now we're looking at gold as that saving grace.
I agree with everything she's saying. And let me add this, Dan, and then we can move on quick. First of all, I don't think the gold trade is, I don't think it's as long in the tooth as people would think, despite the fact that the price has done what it's done over the last year or so. And I think Elizabeth's point about a lot of people talking about it clearly, but it doesn't mean on the retail side people are in. I think has been and will continue to be a central bank trade. And without sort of traversing into the world of politics, I think what we've seen over the last couple of weeks, the norms that have been in place since World War II, those norms don't necessarily exist. So the repatriation of gold that we saw 15 or so years ago with the Bundesbank, I think you need to read more and more of those types of headlines going forward about countries that want to physically control and have their gold within their borders. And that, to me, is sort of the next leg of this trade. So that's what I'm waiting to see and hear over the next couple of weeks.
It's resource nationalization too, right? When we talk about resource nationalization, it's not just what are the resources of sort of that survival of the fittest, right? And economics 102 or 201, right? Which is like, oh, this country is rich in steel, so they are, protecting that resource. Gold is resource nationalization, but around the globe. Everybody can get it, and then they're sort of putting their arms around it and saying, mine, this is now my safety, right? And I think that trade will continue because, frankly, as long as this administration is in office, we will have geopolitical upheaval, right? We will continue to have
volatility,
sort of these feelings and the weaponization of the dollar and things like that, and central banks just not necessarily feeling like they've got control.
Yeah, I mean, again, on the geopolitical front, like you just mentioned, and the volatility and around it, I couldn't think of a better reason for gold to go higher if you listen to Mark Carney, the PM of Canada, the speech that he gave at Davos. And it was very clear. And Guy, you started off this conversation. I mean, everything speaks to that all of our allies are they're just questioning, you know what I mean? This kind of, order that we've had post World War II that we led the way on. And now the potential breakdown, not just of NATO, but also the idea, the threats, not just, military, like from a military aspect of taking, a sovereign, country, if you will, but also the economic threats, you know what I mean? Like by doing that, coercing through tariffs, and every single point that Carney made and every single thing that a lot of our allies were speaking about privately at this event. I mean, I don't know how, and I'm just going to use your expression, Guy, all roads lead back to gold for the very reasons that you guys just mentioned. So listen, I can't buy things like this. Now let's do the flip side of this. Let's pull up the Bitcoin, because you just mentioned it. I mean, man, if it can't go up, Guy, in an environment like this, what the hell would it go up for? I mean, let's think back to one of the main pillars was that it was a store of value, right? It was supposed to be non-correlated to, a lot of risk assets that are meant to go up on a sort of risk-on environment. Well, if gold has doubled in the last year and this thing, can't really get out of its own way, look at it, it hasn't done anything in a year. What the hell do you own it for?
I can't answer that because, again, most people out there in the crypto world clearly know more about this than I do. Let me just flat out say that. But to your point, we play this game. If you had told me all these things were going to take place over the last couple of months, if you had told me that back, let's say in October or so, and you say, okay, I want you to tell me where the price of Bitcoin is going to be on January 22nd, given everything that's going to happen. I'm telling you it's going to happen. And I would have said, you know what, given all that, given where gold is, given this de-dollarization trade, all these different geopolitical things, Bitcoin has to be north of 125,000, if not 150,000, making new all-time highs, because everything you just told me are some of the reasons that Bitcoin was created in the first place, and it's not happening. So here we are sort of languishing in the high 80,000s. I think I've made my view pretty clear, and I will continue to say, I think it's a matter of time before Bitcoin tests the levels that MicroStrategy is long at, and that's about 76,000 or so. And again, I don't know what happens if and when, but what I'll tell you is, and I believe this, and I think there's probably data to back it up, there's a huge overlap between people in the crypto world and people in the AI trade. And if one of those unravels, almost by definition, the other one should as well, in my opinion.
I think there probably is a decent amount of overlap. There are a few things I want to sort of propose here, and these are more questions because I don't know if they're the answer or not. But part of this too is, let's take AI out of it for a second. For a long time, people proposed that either you were looking at Bitcoin or you were looking at gold as a store of value, and you had to choose one of the two, and Bitcoin was the new gold, right? It was the new world's gold. And then we figured out that that didn't really make sense because there was no correlation between the two, and that Bitcoin for the last couple years has actually been more tightly correlated to the NASDAQ than anything else. But that correlation has recently broken down. So I think there's part of this where we had a leverage unwind too that took Bitcoin down quite a bit. But now I think investors are trying to figure out, well, what am I using it for? What is it supposed to be correlated to? And that is, I think, a main question that I'm not sure we have the answer to. The other thing I would say, so I think what we can conclude from that is that it's not a choice between Bitcoin or gold, right? I think they're different investors. I think they're people doing it for different reasons, which means then where is the overlap? And Guy, I think you're right. There is a lot of overlap between, I'll call it just tech and innovation investors and Bitcoin owners. Something else that I heard yesterday, I recently recorded a podcast with Jan van Eck, CEO of Van Eck, and he talked about the idea that when you look at Bitcoin, the prevailing wisdom had been that it goes through 4-year cycles. And that if that 4-year cycle persisted, 2026 was when it was going to be due for a drawdown. It would be due for a correction, and then it would find new upside after that. So in anticipation of that, in late 2025, people sold off to try to get ahead of this 4-year cycle. Well, now the 4-year cycle is busted. It didn't work because in 2025 is when it had its drawdown. So that became a 3-year cycle. Mm-hmm. So here is an asset that maybe isn't brand new, right? Wasn't just birthed yesterday, but is still pretty new to the investing public. And we're trying to figure out, what are the cycles? What kind of cycles is it supposed to be in? How long do we own something like this? How do we even set expectations? And I think we're watching some of that play out.
Yeah, I mean, a lot of investments, a lot of risk assets are about narratives, right? And we just you guys just spent 5 minutes talking about gold and the narratives and why it will work, why it won't work. And there's, financial reasons, there's geopolitical reasons, there's just, I guess, physical, right? There's a whole host of things. It's hard to come up with that. And when you have these folks who are in the weeds, maybe they're thinking about, 5-year, 10-year cycles where you're building on top of this. You're looking out there and you're looking at tokenization of things that like stocks and this and that, whatever. Fine. Right now, if that's your view, and you're smarter than me about it and you're putting your money where your mouth is, fine. Maybe this is just look at that chart. You see the cycles and this is just over a 1-year period. Guy, you've been talking a lot for a while, much like gold, you've been talking about Japanese buying yields, and Liz has her note. Guy, I don't know.
I it's like we're in each other, right? Yeah. Elizabeth, is this true? Yes or no? Like we share a brain sometimes.
Sometimes, yeah.
And something happened this week, and Liz's note will speak to this. We might as well, but let me tee it up.
Yeah.
Japan is not a developing economy. Japan is, I think, the 4th biggest economy in the world, if not 5th. I think Germany and Japan go back and forth. Not that it matters, but here we are. So what we saw this week in the Japanese bond market, I think, is historical for a number of reasons. And the fact that Elizabeth's note speaks to this just warms the cockles of my heart. Back to you, Dan.
I don't even know what to say to that.
I don't either.
Okay, so Kai, every week, Liz writes a note with Mario, and they're focused on something that I think, we should be focused on. That's what they're doing, and they're breaking it down. And, we get a preview of this note, and we're very fortunate to have Liz here. You can have this in your email box. You have to go to SoFi.com/what, Guy?
/Liz. Yeah. Because you know what? You know why?
Why?
Because Anthony Noto, a West Point grad, finally came to his senses and said, what are we doing here?
What are we doing? Let's just make this plain and simple. SoFi.com Liz. Get your money right all in one app. And you know what? You can get your research all at one website. Liz, talk to us a little bit about what you're focused on this week.
So, okay, what happened on Tuesday? Here's what happened. We had a 27 basis point move in the Japanese 30-year bond, which is the largest move ever recorded in the history of time. It was a 7 standard deviation event. For those of you not familiar with statistics, that's big. A 2 standard deviation move is usually the extreme. So a 7 standard deviation event is ridiculous. And the fact that Guy mentioned this is not a developing nation, he said that because moves like this you might expect out of developing nations that do not have mature financial systems, that do not have mature financial markets, maybe that don't have a lot of liquidity in their markets. So you see movements like this on a more regular basis. Japan is clearly not in that camp. So this was way outside the norm. So it's not just to say, okay, here's what happened. I think the more troubling thing was that there wasn't really any catalyst. It just started happening. And we can point to some of the causes, right? Investors are worried about there being more fiscal spending and some cuts, tax cuts in Japan. So then clearly the fiscal situation deteriorates just because of the math. But in one day, they suddenly decided that that was a problem. That wasn't new news on Tuesday. So the fact that there was no catalyst here is disconcerting, because then it means we can't set expectations. This turns into a runaway market very quickly, and investors are caught flat-footed trying to figure out how to basically save themselves, which is what happened on Tuesday. You saw a lot of hedge funds starting to unwind their positions. Then if this starts to affect things like currency markets, you've got that issue that then is a domino on all of it. Now, the move reversed about halfway in Wednesday's trading. The yield came back down about 15 basis points. That's not comforting, though, because that level of volatility is still so big. And this comes at a time that I think everybody's aware of, that the Japanese central bank is raising rates, right? In contrast to many other central banks that are cutting rates. We've got a ton of volatility in the yen and clearly a lot of exposure for investors around the globe. So as this continues to happen, then the question is, how does it affect us? Why do we care? As those Japanese yields rise, treasuries become less and less attractive to investors, which also means the dollar becomes less and less attractive to investors. So as Japanese yields rise, you're going to see treasury yields likely rise, especially at the long end of the curve, which did happen on Tuesday. And you likely see either a lid on the dollar, right? It can't find strength, or the dollar even deteriorate in that scenario.
Guy
mapped it out. I mean, perfectly. And we'll look at the next chart as well. I mean, it's exactly right. And one of the reasons, and we've been talking about this for a while, this is yet another reason that I think the gold trade is going to continue to work. And Japan's got a problem. And you see something like that, the network doesn't spend enough time trying to explain the ramifications. But all you have to do is go back in time, go back to the July of 2024, when you started seeing their currency strengthen in a meaningful way on the back of a CPI report here. Dollar yen went from 167 to 161 to 157 in about an 8-minute span, which doesn't sound like a big deal, but I'm telling you, historically, that's a big deal. And by early August, our stock market was cratering on the back of this sort of carry unwind trade. And, now history is sort of repeating itself. The only difference here, Elizabeth, and I think you can speak to this, is exactly what you just mentioned, that the bond market is now sort of eroding before our eyes. That was not happening 2 summers ago.
Right. And that was, which we probably talked about, a relationship problem at the time. It should have been eroding. Now it is, right? It's not something that we wished for. It's just that it didn't make sense at the time. So now it's starting to make more sense. A move like this doesn't make sense, or at least of this magnitude doesn't make sense, but at least the relationship seems to be intact. So to the next chart, I alluded to this already. When you look at what happened in the U.S. bond market, the treasury market, we did see yields rise. We're only showing you the 30-year yield in the next chart.
There you go.
Great. So the 30-year yield is in magenta. So we did see our 30-year yields rise. And keep in mind, this is happening at the same time as Davos started. The World Economic Forum started in Davos. We're hearing from leaders all over the globe. There was some drama. There were people walking out of dinners. There was a lot of drama about Europe, Trump threatening new tariffs on Europe if they didn't support our acquisition of Greenland. So then this Sell America trade started to heat up again. At least that was the commentary that was heating up, because if if we're threatening tariffs on Europe, well, maybe then European countries are also going to dump our treasuries because they're trying to protect themselves, right? And it turns into this protectionist theme around the globe.
It's my understanding, though, that Europe as a bloc own, I don't know, less than 10% of treasuries, just to be clear, correct?
Yes, so they're not a large
And
owner.
this is what Besant said. I mean, you know, the one thing, and sorry to interrupt you, Liz, it's like it wasn't just walking out of dinners and you know, we talked about Carney and stuff like that. It's like it seemed like every like representative from our government was trying to put a thumb in the eye of somebody over there. Scott Besant like set the stage. He got there before Trump did, and he's making threats and the sort of threats that got walked back a day later. And this is the sort of volatility that I think speaks to all of this, the Sell America, because I think a lot of these countries are looking at us and saying, we don't know what the clear message is.
Correct.
We don't know if these guys are going to be supporting us economically, threatening us, that sort of thing. And so I don't know how this abates anytime soon.
Yeah, I would agree. And when you think about, I want to be clear too. I'm not saying that this is a hate America trade, right? I don't think that there's necessarily.
It's a hedge.
Right. But it's about setting expectations. It's that countries don't know what to expect. And so far, Davos has not necessarily been a feel-good conference for most countries, including the US. So here's what we saw on Tuesday and into Wednesday. You see a blank spot there on Martin Luther King Day because the bond market was closed, but a rise in 30-year yields, a drop in the dollar, because everybody's just trying to figure out, well, what now? And how do I lower my exposure to all of this uncertainty?
That's it. Recalibration is exactly what you're speaking of. You know, we're reevaluating the relationship or the extent that we have U.S. dollar exposure, U.S. bond market exposure, U.S. exposure in general, and we're recalibrating based on what's going on. And that recalibration is happening in real time, Dan.
Yep. And you know where to find this note. You want it every week. Go to SoFi.com/Liz.
I'm so happy that, it makes me so happy. Really, I mean this.
All right. I want to hit some single stock stuff. Then we got to hit Butters, and I know we got to get out of here. So questions, we're going to get to plenty next week. We won't be here tomorrow. Just really quickly, we're getting to tech earnings. You and I are going to have a little conversation. It's going to drop on the Risk Reversal podcast on Monday about what we're thinking about into the big cap, mega cap tech stocks. Guy, GE reports the guidance looked pretty good. Stocks down 7%. And I'm not trying to tee you up. I'm just saying this has been, a really big winner. And this is kind of the story that we've seen a little bit. We saw this out of the banks, and then there was kind of news in and around credit card fees. This obviously has nothing to do with that, but that's a big move for a name that's been a big winner over the last year.
I'm not concerned yet. And I know Elizabeth doesn't want to play the single stock game. I won't make her do that, but the good news is that basically, number one, it just recently made a new all-time high. I think 332 or so, or those around that level. Since June of last year, we have seen, I think, 4-ish moves to the downside of this magnitude that over the course of a couple of weeks were worked off, and then we subsequently made a new high. So this does not alarm me yet. Now, I would say this: if we trade down to sort of 285 or so, which was the recent low in December, we'll have a different conversation, because what we've been doing until recently has been making a series of higher highs and higher lows. What I think is happening here, this is just giving people an excuse to take some money off the table. That's my take on it. And again, I'm not suggesting I'm right, but there you go.
Yeah, and we have an S&P that's obviously, within a whisper. What do you use?
I think it's whisper.
I say
Whisker.
But, I love
that's
cats,
like a kitty cat. Yeah, you do. You do. She used to have a cat named Itty.
I'm going to say something to Elizabeth. I said this to you. Let's see if Elizabeth knows. I know we have to get out of here. Elizabeth, you ready? Just close your eyes for a second. Think of this. Call me cat.
What?
Let's just say, okay. Call me kitty cat. Does that mean anything to you?
No.
No. Okay. Back to you, Dan.
Proctor's up almost 3%.
That was, by the way, Dan, you got to gloss over it. That's, of course, from Wedding Crashers, if you remember the scene in the bedroom. But back to you, Dan.
Freaky stuff. Really quickly.
Call me cat.
Proctor.
Okay, cat. Call me kitty cat.
This was a sector we thought Staples might have a bounce, into the new year. I know what you're going to say, Guy. Maybe you get yourself to 154-ish. That's the 200-day moving average. But is there a fundamental case, and I want to get your take, Liz, for Staples? Guy, is there a fundamental case first for Procter & Gamble?
I don't think so. I think this is, again, you've seen moves like this before. If Amanda wants to go a little bit longer term, I mean, this has been in a pretty significant downtrend since March of last year when it was 175. So you can draw the trend line, and what you'll see is we're basically right at this downtrend line. So all I think is this is just a bounce that we've seen a couple times before over the last year. Now, if we break this, we visit 155-ish. You just said that, but the moving average is sloping meaningfully lower, and I don't think they're out of the woods yet in terms of being able to pass on higher costs, and their margins have been deteriorating. So I look at this as just a bounce off an oversold condition. That's me.
Yes, give it to us, Staples.
So can we pull up the XLP, please, which is the Staples ETF, which looks much different right now than the Procter chart. You see that big bounce on the end here. So Staples was and is one of my calls for 2026, but not necessarily for January, right? This is something that as investors try to diversify away from high valuation stocks, try to participate in that broadening out trade, you don't expect Staples to be a cyclical broadening out participator. So this is one of those situations, an ETF, that I would say it's not all supposed to go up at the same time, but you want to be in it when it's cheap like this, because later in the year, when we start to heat up with midterm elections, Staples tends to be a good performer. Healthcare is another one of those good performers. So I feel right now about Staples the way that I felt about healthcare early in 2025. I continued to like it. I continued to own it. I continued to add to it during opportunities. I just have to wait for it to work. But I still do think it will work later this year.
Guy, remember that time Lumpy said, have you tried Staples?
Yeah, that was, of course, and Scrooged Lumpy. By the way, visualize this chart, people. I want you to just, okay, now, Amanda, put up a Costco chart, because I think Costco is about 9% of the XLP, and the move we've seen in Costco recently mirrors what we're seeing in the XLP. I think the largest component is Walmart. So I think Liz is onto something. Now, Procter participates, then the XLP is off to the races, but it's now you need Procter to sort of continue doing what it's doing, because I think that's the third largest holding, Dan.
Yeah, and you and I were kind of leaning into this whole thing. I mean, I was definitely, as we got to year end, and just throw up Walmart really quickly into the pairs trade of selling Walmart, buying Costco. Walmart is kind of held in there, but you've gotten that outperformance of Costco. Before we get to Butters, two names report after the close. Capital One, and Liz, maybe you can just speak to thoughts in and around the threat of capping interest rates on credit cards. Now, he's just talking about that would be the president for 1 year. We know that the 1 year gets us through the midterms. It's not likely to happen here. If this company puts up a good quarter and good commentary, we filling in the gap, or I'll leave that to Guy, but do you think that we're likely to see, some of these names with heavy exposure to credit cards rally back?
I think there would be a little bit of a relief rally, but I think we've already seen that. Capital One got hit the hardest in this because it targets more of that lower income consumer. So the idea was that if there were caps on these rates, that companies wouldn't be able to continue offering credit to consumers, and a lot of credit would be canceled or taken away. And then a lot of those consumers would lose access to credit, which obviously is not a good option for anybody across the country. So that's not something that was likely to come to fruition in a midterm election year. I believe the deadline was the 20th for that to actually happen. Nothing happened. So it kind of went by as a nothing burger. And now maybe it dies on the vine. We'll see. But I do think there'd be a little bit of a relief rally if it completely went away. I understand the theme behind it, right? Trying to attack this affordability crisis, but we can't attack it by taking things away, right? We can't attack it by taking privileges away from consumers. So there has to be a better option.
Who is the most important banker in the history of mankind, Dan Nathan?
JP Morgan.
Alexander Hamilton.
Ooh. Okay, those are two good answers.
I know what you're going to say, Jamie Dimon. You're going to say
Dimon. I know, yeah. But I mean,
don't you think that
JP
answers. Morgan would have been a little more important, the guy who's the bank's named after, than Jamie Dimon?
No, it's all fair. No, you make an excellent point. Let me rephrase. Who's the most important banker today?
Living.
Jamie
I would say Jerome Powell.
Yeah. a negative ghostwriter, as Elizabeth said earlier. Now, you don't need to hear what I have to say about capping credit card rates because it doesn't matter what I have. Listen to what Jamie Dimon recently said about it and how, in his words, and I'm paraphrasing a little bit, catastrophic it would be to the economy. And he's right. The unintended consequences of that would be staggering. Now, I'm sure in this case, very well intentioned. However, the unintended consequences would be problematic.
All right. I got to go on a quick rant, and then I got to get your take on it. So Intel reports after the close today. The stock is up nearly 50% on the year. It was up 100% on the year last year. We know what happened. The stock was 20.5. The administration converted the capital that there was given to this company under the CHIPS Act to stimulate demand here or at least for creation of fabs where Intel would gain other customers here. They'd bring back that manufacturing away from Taiwan, diversify supply chains. So $10 billion at 20.5. Okay. Then about a month later, NVIDIA, and I have to think at the urging of the administration, takes a $5 billion stake. This is a competitor to Intel at 23.25. So if you ever wanted to kind of get your hands around whether the stock market is rigged or not, this is kind of exhibit A. But Intel's a company in 2021 that had $80 billion in sales, $5.50 in earnings, gross margins of 58%. In 2025, that'd be just last year, okay, they are maybe going to do 35 cents in earnings, maybe $57 billion in sales, and their gross margins are down 21 points. 21 points. So you look at the move that the stock has had here, it's moved in government backstop, maybe the secular theme. They have this manufacturing process that if it is successful with their own chips, they're going to attract, other customers. And this is going to be the dawn of a new manufacturing age of semiconductors here in the US. So the move that we've had is anticipation of all of this. Okay. So when I think about this, when they report after the close, maybe they don't have to beat the quarter that just ended, but they better guide up for the year and they better have good data about these processes and what they've been able to do. Because even with the government backstop, if you will, I don't think this administration has any, there's no illusions. To build fabs, it takes 2 to 3 years. And they're competing with a sort of behemoth in Taiwan Semi that the world has never seen, in my opinion, in manufacturing of technology. So there's not a lot of things, in my opinion, lining up for the stock, given the rally that it's had over the last.
I promise on Monday, if this stock is up 10%, I will say, Guy, you're a jackass. Although that's typically what I say anyway. But the fundamentals of this company have not changed one iota since that investment was made in the low 20s at all. And then the subsequent announcement from NVIDIA, nothing changed. I mean, this is still a business that's been in decline now for the better part of the last 5 or 6 years. I mean, the world has lapped them. And I don't see anything that indicates that trajectory has changed. The only thing that's changed, in my opinion, is the valuation, which is probably close to 92 times next year's numbers, which I think we both agree is a little absurd. So I don't know what they could possibly say. Unless you hear about another tranche stake taken in Intel, which I don't think you're going to hear, I think this stock is setting up for a significant move lower, my opinion.
And to your point, I mean, the stock is basically almost back to where it was when it had $5.50 in earnings. So any earnings growth off of a low base, might look. I
just pulled that up. So back to 2021, right? Its high in 2021 was 68.26. It looks like. So it's about 20% below that high right now, but it's made a big move. It's above its highs of 2023-ish. So what is the right price here? Because it spent a lot of time down in this $20 to $25 range between 24 and 25. And it spent a lot of time closer to 25 to 30. That would be a pretty big drawdown from here. Is that the right range? And then when do you buy it, right? Do you buy it in that $20 range?
But listen, if I was the company, I'd be selling stock hand over fist. Now,
there's no way that they'd be allowed to do that.
The government would sell. They'd front run that, I think. But listen, it's been a great trade. They bought $10 billion at $20, and here it is at 55. All right, if it's Thursday it's Butters. And that's what Guy had already teased us with a little bit. So that would be John Butters. He's the senior earnings analyst over at FactSet. Each week, he writes the Earnings Insight blog. You can get it in your email box at factset.com/insight/subscribe. Guy, I think we need to talk to our friends at FactSet because Liz has started a trend here. Maybe it should just be factset.com/Butters,
bitch. Can you imagine if they did that? That would blow up. What do they call when you blow up the internet?
You blow up, they break the internet. All right.
I'm like, I can't get my head around that. Would I mean, people would do it just like, oh my God, I can't believe I'm doing this.
So, Guy, I'm just gonna need you for 20 seconds.
Look at Elizabeth,
keep it under wraps. You ready here? If it's Thursday, it's John's Butter. He's the scene. If it's Thursday, we get a look at John Butters, his weekly note at the Earnings Insight blog. You know where to get it. factset.com/insight/something/subscribe. And it's a great read. You know, this work that he does, Guy, on weeks like this, as we get into the bulk of earnings, I think is really, really important. So let's get through this, Liz. We'd love to get your take on some of the things that John is looking at. All right. So he's looking at the blended growth rate in earnings for the S&P 500 for Q4 2025 is 8.5%-ish. Okay. What's important to this is that we're getting into the bulk. We had the banks, right? We saw generally good numbers, good earnings growth, that sort of thing. I think most of the focus, though, as John is pointing out, the Mag 7 companies are projected to report earnings growth of 20.5% for Q4. So you see that spread. Talk to us how you're thinking about the 493 versus the 7 in earnings growth rate, because obviously that 20.5 is a huge delta between the 493.
Well, since this is still for 2025, I think that this probably makes sense. Although the stock market didn't react as if this was the case, right? It didn't react as if we still should be buying these stocks hand over fist. There was volatility clearly and a recovery, but to my point, it didn't look like this on a daily basis in the S&P. In 2026, technology is still expected to be the best earnings growth generator, but materials not far behind. So I think that there's going to be a really interesting earnings story in 2026. I would not be surprised if technology companies underwhelmed on earnings, but the expectations are so high that even if they underwhelm, it could still be strong. But I also won't be surprised if we see some other sectors actually come in and surprise to the upside. Maybe materials is stronger than anybody expected. Maybe financials are stronger than people expect. So I think that this gap will start to close in a material way as we get through this year.
Guy, the blended that's actuals plus estimates earnings growth rate for the other 493, 4.1%. Is that speaking to an S&P that should be trading at 22 times its higher trailing?
Not in my opinion. And, you know, you are what your record says you are. So if you look 8.4%, you know, that is fine. But how did you get there is the problem. And, you know, Elizabeth's point is spot on, because if you go to the 2026, you'll see that we're going to go from 4.1%. We're almost going to triple that for the other 493. So that skew is getting sort of worked off a little bit, but that's estimates for 2026. And man, if you want to throw that chart up, you can look at it. Now, I'm still hard pressed to believe that we're going to get there because it would require a number of different sectors to participate. I think you can get it in materials, and I think to a certain extent you might be able to get it in energy, but I'm not sure if enough sectors are going to be able to participate to triple what we saw last year. So we'll
Liz,
see.
I'm assuming you like this chart better than the trailing 2025. You kind of just spoke to that a little bit, because this does speak to a broadening out of earnings for, you know, away from, obviously, as Guy just said, away from those Mag 7.
Yeah, I mean, investors should like this chart, right? One of the biggest concerns that we've had for the last couple of years is that market concentration was making it so fragile. We were too dependent on these 7 names or maybe even 10 names in the indexes. And we should be becoming less dependent. That's a healthier place to be. So even if earnings come in below expectations, hopefully they come in from other parts besides tech, right? And it's okay if some of those earnings and the profit margins are expanding because of tech advances and because of productivity gains. That's fine, but it needs to start reaching its tentacles into other sectors. So this is, again, this is estimate, right? This is just what we hoped, I guess, to happen in 2026. It may not turn out this way, but either way, you want the gap to close.
All right. You guys know where to find it. FactSet.com/insight/subscribe. John Butters puts it out every week. We get a preview. All right, guys, we covered a lot of ground. We covered Liz's note. We covered Butters' work. We hit a little earnings looking back, a little earnings looking forward. You guys covered the hell out of the gold trade. We're still trying to figure out why the folks buy the Bitcoin. And Guy is going to keep focused on that Bitcoin price relative to MicroStrategy's holdings average price.
And you also, we asked why Dan's wearing a flak jacket to work today. I guess somebody, you worried somebody's going to hit you with a baseball bat or something.
Dude, it is so cold out right now.
It's not that cold today. I don't think.
Okay. So, Guy, you and I are sitting down with David Rosenberg. You just called him
Rosie
of Rosenberg Research. Rosie's our man. We love Rosie. That's going to drop in the Risk Reversal podcast feed tomorrow. So go check that out and, kind of rate it, review it, share it with friends. That's how people find it. But Guy, what do you want people really to do? I want
people to slam the shit out of the like button. I also want people to go and listen to Jackson Browne's Running on Empty album, which I believe was released in 1977. There's a song on that album called Rosie.
Really?
Now, yeah, but when you read the lyrics, it has an entirely different meaning than.
Who's your second favorite Rosie? And you might have gone to the prom with her back in the day. I don't know.
There was a woman that took our lunch cards IDs at Georgetown in the 1980s. Her name was Rose. Nice. And she was militant about. Now I know we got to go. You brought this up. Amanda's great.
Bring it up.
So she would look at your ID card, and I still have my Georgetown ID. I'll share it with you one day. Nice. And it had little holes in it, and that would sort of, you put it in a scanner, but she'd look at it, look at your face, look at the card, put it in, and if you went through and you ate lunch. My brother came to visit me one day from high school, and I gave him my ID card with my roommate, and he brought it to her. She looked at him. She said, "This not you." And she took it, and she kept the effing thing for like a week. I couldn't eat lunch for a fucking week.
Wow. Rose,
I
took her job seriously.
Thought you were going to go with Rosie the Riveter, but that's a great story.
Well, that was when I was in high school. I mean, during WW2, the big one.
All right. The big one. You dropped two big ones. What movie? Oh, gosh. What movie?
I don't know.
It's Fletch.
Oh.
All right.
I got it.
You got a 5,000. We got a big. We'll also see on CNBC's Fast Money. Liz, will you be on the HTR?
You know what? We won't see on CNBC's Fast Money. Elizabeth Thomas. You know why? Because she refuses to do the show.
Someday.
You know why? Because she likes the SDs on the HTR.
All right. Hey,
I don't understand.
You got to get in a car.
What are you drinking? That looks, oh my God, that color is
our next sponsor, Juice Generation. All right, thanks everyone. We'll see you next week on Monday.